Hello, everybody, and welcome to the exit panel for the day. I hope you see what I did there. A good couple of chuckles from the audience. Great start. The way that we're going to begin is with a couple of introductions. But before we do, I just want to ask you, are there any founders in this room who are looking to exit at some point? Put your hands up. So that would be every founder that we have here, right? This panel is 100% for you. This is the left to right of exit strategies, and we have an awesome panel here for you today. I'm going to let them introduce themselves for you. I'm Nikita. I'm from AWS. I work with scaling startups, so startups who are around that seed stage all the way through to B, C, and beyond. And they're always asking me, who is it that I should speak to about my exit strategy? What is it that I need to know? What don't I know? And this is the panel that I will be directing them to in the future. So without further ado, I'm going to hand over to Sasha for an introduction.
Thanks, Nikita. So Sasha Conoplia, I'm Business Development Manager at ASX in the listings business. So the main question I get asked is, what do you do? So my colleague Amit and myself, we go and talk to the whole community within the sort of financial markets and beyond. So we talk to founders, we talk to investors, we talk to the bankers, we talk to the lawyers, we talk to the accountants, the full end to end. So really well connected. We have very, early stage conversations on what people want to do in regards to an IPO. It's the eventual kind of bell ringing ceremony, which is not the end, and I'll go through that in a minute. There's lots of people we can connect you with. We engage with the community very closely. We do a lot of education because people don't know what an IPO is, and there's a lot of elements to it. So that's what I help out with.
And just as we go through these, Sasha, if I could get you to give an example of a company that you've helped through an IPO as well, that would be great. And we'll do the same with you, Madeline and Jamie.
Yeah, look, one that came to mind was SiteMinder, and that was, I think, sort of late 2021. That had a really interesting journey. As the questions come through, I'll sort of maybe use that as a bit of an example. So, they listed with a market cap about 1.3 billion. So, pretty chunky size for our market. They raised about $650 million of capital. 500-ish of that was actually a sell down for investors into the IPO. And I'll go through a bit more of the metrics around that, but that's a really interesting example.
Thank you so much. So that's Sasha from the ASX. Madeline from Allens.
Hi, everyone. So yes, I'm Madeline Hunt, and I am a senior lawyer at Allens. I'm a corporate lawyer in our technology team, and I'm also a member of the Allens Accelerate practice, which is essentially a practice within the firm that really focuses on high growth companies and supporting the startup ecosystem. So what I do as a lawyer at Allens is a lot of tech-based M&A work, so helping startups from the very beginning as part of the Accelerate practice with their initial seed raise, Series A raise, all the way to an exit. So generally, the work that I do is in the kind of sale, so a share sale or an asset sale. As an example, a good one that comes to mind was actually about this time last year. We did an exit for Playground XYZ, which I suspect a fair few people may have heard of them. They're in the kind of advertising technology space. They do amazing work, and they were acquired by a US tech company, a big company called GumGum. And that was a share sale transaction and a really interesting one to work on. So hopefully some learnings from that for today.
Awesome. Thanks, Madeline. Jamie from Blackpeak.
Good morning, everyone. Jamie Taylor from Blackpeak Capital. Blackpeak is an independent corporate advisory group. We've been around 8 years now. We're very active in the tech space. We've done about 50 transactions in the technology space in that time. We've done a lot of private capital raisings. We do a lot of sell-side M&A, including the deal that Maddie just mentioned, Playground XYZ, and we've done 5 IPOs. So the cornerstone client for Blackpeak was Richard White, who was the founder of WiseTech Global. So WiseTech's probably the dream founder story that a lot of people in the room would love to emulate. And so Richard basically built his technology in his garage. Fast forward 20 odd years, he listed on the ASX with market cap of $1 billion, which we advised on, and market cap today is about 18 billion, and he's retained 50% of the company. So he's done pretty well. Another one I'll just mention is, which is topical, is Elmo Software. So Elmo was the second IPO we did. And again, that business, Danny Lessam had been working on the business for 10 or so years, listed, raised 3 rounds of capital, made a number of acquisitions, and they're now under takeover from K1, one of the North American growth equity investors. So that's sort of a bit of a lifestyle story, life cycle story, I should say.
Hashtag founder goals. I'm going to stay with you there, Jamie. What are some of the common exit strategies for founders, and how do they pick the right one?
It's all situation specific. I mean, it depends on what the founder's looking to do. We have some founders like Richard who he saw the IPO as just part of the journey. He's going to continue running that business, growing the business, and that'll be his journey in life. There's other founders we come across that see the liquidity event, it might be a trade sale, it might be an IPO, as more either the exit event or a step towards the exit event, because they've got something else they want to do in life. They've got another idea they want to incubate. So it depends on what the founder's looking for. But often, everyone's heard of, the seed, the series rounds through to a liquidity event. It's a journey, and it depends where the company's at, what they're looking to do. Are they looking to raise growth capital because they're at the start of building their business and they want to take it international? So it's a matter of what the founders are looking to achieve. But I think having something in mind is important, but also knowing that there's options out there and being prepared for those options. You may think that growth equity round is the right idea to keep scaling the business, but you might get the knock on the door with the knockout offer from a strategic investor. And but the key thing is, and I'm sure we'll probably talk about it, is being prepared for one of those events to occur and making sure, one, you run it efficiently, but you don't lose the opportunity because you're not prepared.
Awesome. Any colour to add there, Sasha?
Yeah, I think, I agree with all your points there, Jamie, about certainly being prepared, the drivers of the founder, how much, at the end of the day, there's a lot of blood, sweat and tears that goes into building, as we've seen for the last couple of days. So, there's a money event at the end that everyone's kind of, aiming for, in addition to obviously growing a fantastic and sustainable company. So choose the right thing at the right time for you. If I give you some metrics around sort of IPOs, I don't really consider it, and you mentioned it, Jamie, as just part of the journey. So when you say, is it an exit event? Well, it can be a partial exit event. There's a sell down process. So, I mentioned SiteMinder, they raised 650, sort of 600 odd mil, 500 was for sell down. So TCV, for example, a big US fund, had 22% of SiteMinder. They were able to exit 100% of that position through that IPO. Their fund had come through to maturity, was actually past the 10 years or 11 years. So they chose to sell down, and the market was able to absorb that sort of sell down. Some others sold down a little bit more to sort of balance portfolios. Others stepped in, the BlackRocks, the Aussie Supers, the institutional investors stepped in to that. So, there's different things, and that company now has, it operates in 150 different countries, has 30,000 sort of customers, other hotels that use their e-commerce sort of booking platform. So, and they've got obviously their compelling growth story coming out of that now as a listed company.
Thank you. And Madeline, any more specificity around asset sale and share sale in that exit?
Yeah, so just to kind of take us back to first principles, when we're talking about exits today, we're going to be generally talking about an M&A transaction or an IPO transaction. And as Sasha said, there might be a partial sell down as part of an IPO, but an M&A transaction is much more of a sell down. And for that, you're either looking at a share sale, so your company and the shares in your company are being sold to the acquirer, or an asset sale, which can be a specific asset or more likely a group of key assets or all of the assets of your business that you're then selling. And whether or not one is better than the other will depend on, a variety of factors when the time comes. Often tax is one and liability is one, but they're the types of transactions that this panel is really going to be talking about today.
Awesome. And while we have some free time with the lawyer, a couple of other questions for you. How does either an M&A or an IPO change founder control or equity in a company?
So starting with an M&A style transaction, unfortunately, the answer to a lot of these questions, and you'll hear this from lawyers all the time, is it depends. But the reason is because the transaction can be structured in just a variety of different ways. So you might actually have an acquisition where you've built this fantastic product and there is a very large business that wants that, and that's just what they want. So they buy it and that is the end of the founder journey. There is no more control because you have completely exited the business. Essentially, they don't need you anymore because you've built this self-serving, amazing product. But a lot of the time, the exit is in relation, it's something that someone wants to add to their business or they want to then take over that business. And so they need the founders and key people to stay with the business and stay on the journey. And the founder might want that as well. And so for that, you might see a partial sell down. So they retain some equity in the company. When you go to control, they're not retaining control. When we think about an M&A transaction, we often call it a change of control. That's essentially what happens. But they can still be very active in the business. So they can still hold shares in the business, or they might participate in the new acquirer's management incentive scheme. So like their employees that participate in an ESOP, in a similar way, they're still part of the journey and they're still interested in the growth and development of their business and the new path that it's taking. So generally, you are relinquishing control as part of an M&A transaction, but you can still stay involved. I don't know if Jamie or Sasha want to talk to IPO and continuing founder involvement after that process. You already had, I guess. But
yeah, just from a listing rule perspective, to give you some metrics around that. So there's a minimum 20% free float required when you list. So that means 20% of your company needs to be owned by people other than the founders. That's for liquidity purposes as well. There's a minimum of 300 shareholders, each with $2,000, or non-affiliated shareholders, which is the exact definition, owning $2,000 or more of that. So that's a reasonably small number when you look at the type of company and the stage that you're going to be at. Your advisors and brokers can certainly help you with the shareholder table on that. I think, Jamie, maybe you want to elaborate a little bit more, but, listing your company through IPO, you collapse your cap table as well. Everything becomes ordinary shares. So there's possible complexities about the types of instruments you have through your convertibles or your safe notes, etc., that might create some of the ownership issues or dilutions. I'm not sure if James, you want to elaborate on that.
Well, one thing I'll say is, just to skip that for 1 second, is that on your way to that liquidity event that Maddie was talking about, often there'll be a growth equity round. It's really important at that point that you have very good lawyers like Maddie engaged, because you want to make sure you get your shareholders agreement right, and that it's not going to, as best you can, not reduce your options around your liquidity event going forward. You're not handing up even negative control. So it's very important to, whilst you get excited about getting that growth equity in, make sure you get shareholders agreement right. But that's probably a whole nother topic which Maddie could take you through. But so I think that was a key point I wanted to make.
So obviously we've got shareholder expectations and priorities with the founder kind of continuing on. There are expectations and priorities from investors and founders as well as an exit is taking place. Because you're seeing both perspectives, I might actually stick with you for a second, Jamie. Do you mind talking a little bit about what some of those expectations and priorities might be going into an exit?
I think just understanding what you're looking to get out of the exit. And again, maybe I'm repeating a little bit, but often founders will need to stay in. They'll cede control, but they may be required to stay in. So just understanding that there's some sort of alignment with the incoming majority shareholder around what your role is, and when you're going to have an opportunity to take your liquidity event, if that's what you're looking to do. Making sure there's cultural alignment is pretty important if you are going to stay in as well. And it's really important that, you know, it's not only you as the founder, there's other stakeholders as well, importantly your employees. So you should do your due diligence on the investors. When they're coming knocking on your door promising all sorts of things, that's great, and they've all got reputations to protect, but do your research. Ask them for the names and numbers of companies they've backed before, and speak to them and ask them what the experience was like. So I think that's important. It's a couple of things. I don't know if Sasha or Maddie want to add.
Awesome. Thank you so much for that. Which brings us to the all-important question that you're probably dying to understand today. And that is, what is actually the process of going through a M&A or an IPO? What's the timeline look like? What does a startup or a founder need to have prepared in order to take that exit?
I'll kick off on the IPO side. So broadly speaking, we say it's a 6-month process, but it's not a 6-month process. So it's 6 months from appointing your advisors, so your bankers and your lawyers principally through that. But it's really about being prepared much earlier for that. So it's a big strategic decision to IPO. So again, if I take the SiteMinder example, you know, they appointed Sankar Narayan in 2018 as the CEO. So the two co-founders actually then stepped into different roles. The two Mikes, Mike Rogers became CTO, Mike Ford actually became a director onto the board. So they changed their roles. So you've got to look at where you actually are heading well before the time that you sort of head towards IPO on that. Look at the IPO process, appoint your advisors, a due diligence committee process then to get your prospectus prepared. Probably a couple of months around that, I suspect, Jamie, with all the meetings, toings and froings with the lawyers and going through everything in fine-tooth comb. That's a very important part. That's getting your prospectus. That is your one document that everybody is going to rely on in regards to the float of your company. You then have, that then needs to be approved by ASIC. ASX obviously then takes a look, and there's listing rule approvals around that. So that's sort of a 2 to sort of 6 week process in itself as part of that. You then have all your marketing to your institutions and your book build process. So your broker and going out and telling your story. So the management time involved in that is also very important as well. You know, we heard earlier, you know, even for the private rounds, it takes a long time to do that. Yes, it takes a long time to get your IPO up and going. So that 6-month process is probably about as short as you want to be.
Yeah, I might just add, we typically get involved. So at Blackpeak, we play the role as financial advisor in an IPO. So we work on behalf of the board and management team. So we're looking after their interests, and IPOs are a massive time suck on the management team, and they're still trying to run the company. So it's important that you don't get consumed in the IPO process as a founder and let the financial performance of the company slip. So it's important you have a strong sort of team around you. But we typically get involved 6 to 12 months before the 6-month period that Sasha mentioned, because often the company thinks they've got a really good financial model, but there's no way when we look at it, it's going to undergo the rigors of an investigating accountant's report. So often there's months and months of work to build up a proper financial model that's sufficient for Section 4 of the prospectus. And then there's also a lot of work to do on getting the investor presentation ready. And then we will always do a bit of a pre-sounding amongst major institutional investors ahead of an IPO. We give them an early look, and we get feedback from them. And often we might find that some of the feedback means we have to go back and rethink parts of the way they're approaching the business. It might be go to market. It might be that, you know, it could be one of a number of different things. So if you're actually thinking about an IPO, think about it, I'd say 18 months ahead of time. Do all that preparation work, because then once you appoint the accountants and the lawyers, they're on the clock and they're charging you, aren't they, Maddie? And you want to keep that time to the minimum, and run an efficient process. And that's the other thing that we do, is we take charge of the process, make sure it's run efficiently, keep the cost down as much as possible, and obviously take the pressure off the management team. So that's sort of what I'd add on the IPO side.
Just quickly on the financials. So, the listing rules require 3 years of 2.5 to 3 years of audited financial statements coming through. So even thinking about the systems and processes that you've actually got in place to produce those financials, not sort of chasing, you're 2 or 3 months down the track from a half-year sort of end date and you're still chasing what those numbers look like. Actually putting those systems and processes in place well in advance of being able to then produce those statements.
Which I think lends quite nicely into what I was going to say about M&A style exits and the timing, which is you should be thinking about preparing for an exit now. And I don't mean like it all consuming, thinking about it, but a big part of that transaction is going to be the diligence. And so the more you do now to have your business in a really diligence ready space, the easier the transaction is going to be when you eventually get to it. But in terms of timeline, once there is a potential acquirer kind of at the table, it really depends on the nature of your business. So and the acquirer themselves. So if there's going to be an overseas acquirer and there might be some interest from our Foreign Investment Review Board, FIRB approval and that process is obviously going to throw out your timeline significantly. Similar if it is a transaction that's going to raise some competition red flags and you might need to get ACCC clearance, again, that's something that's going to add months to your exit. But if there isn't a need for a regulatory approval process, then actually an M&A transaction can be relatively efficient. Not as efficient as your Series A, Series B. There's a lot more to it, but it can potentially be done in a number of months. And I think the key to that is who the acquirer is, whether they have very kind of cumbersome processes that they need to go through that you kind of have to be a part of, how easy their diligence is on your business, and what that, like the complexity of that diligence. And then probably the final factor is the complexity of the transaction itself. So is this a simple transaction structure, or is it quite complicated with, complicated earnouts? Does it have, like multifaceted aspects to it? Do you have a very, very large number of shareholders with different views that are a little bit difficult, I should say, to corral? Do you have employee shareholders that need to stay on with the business post-exit? And have you thought about how that's going to work with your current ESOP? These are all the things that can make a transaction kind of complicated and time consuming. But the more preparation you do in advance, the quicker that can be.
So it sounds like it's not the easiest thing to execute. Apart from financial and legal complexity, or perhaps including that, but also touching on perhaps culture and market conditions, why might an IPO or an M&A or an exit of some sort fall through? Let's start with you, Jamie.
Okay. Well, there's a saying that time kills transactions, which means delays. And picking up on Maddie's point, being prepared is like the most important thing. And often, we know stories of companies, they go to knock on the door from a strategic acquirer, and they get into discussions, they have a high level agreement on valuation. The acquirers then got to go into their diligence, and we find that the financial model is just not fit for purpose at that point in time, and the company's got to spend 2 or 3 months working on the financial model, and at that point in time the acquirer's moved on. So I think that's one thing that definitely kills deals. Obviously from an IPO perspective, market conditions can kill deals, and again, timing is all important. So preparation is still relevant in an IPO context. If you can run an efficient process, if you had it listed at the end of 2021, you would have been pretty happy, although share price may have taken a whack in 22, but at least you would have got your listing away, got your capital for growth, given yourself then time to build the business. But if you had have delayed the process for whatever reason and you attempted to go early last year, you probably wouldn't have got the deal away.
Yeah, so just to give you a little colour on that. So 2021, there was 241 listings on the exchange. Our sort of long-term average is about 140. Last year, there was 107. So everyone says IPO markets are closed. Yes and no, very sector-based. So there were still 107 listings last year, predominantly in the mining metals, sort of battery green space around that. So there was about $1.1 billion of IPO capital raised last year, sort of 30 odd billion of market cap of the companies that came to market. So that was still there, but you can see the big difference. And we've kind of gone from peak to trough on that as well. But interestingly, the secondary capital markets, they remained relatively open. You know, everything had a price. You know, once you're listed, there's always that liquidity there. So coming back to market, you know, from a listed company perspective, there was about 40 billion of secondary capital that was raised last year. So whilst the IPO market was much tighter, once you are listed and the access to that, so yes, the timing of the market is interesting. The other thing to look at is the market volatility. So you can look up ASX 200 VIX, and you'll see, and people talk about the VIX in the US. The US volatility is higher than the Aussie market. Typically, the IPO capital gets raised when that VIX is in a range of 10 to 15. And there's IPO windows, which is really sort of March to sort of June, and then sort of September to November, December sort of stuff. So there's certain windows where these deals get done, and that's around company reporting seasons and a few other drivers. So just have a look at those as well. But you know, if that VIX gets too high, typically the IPO markets will close. We're now back into that. So the 10 to 15 range, we've since mid-November, we've been in that range and at about 12 at the moment. So conditions are starting to come back. We'll see what February reporting season brings. You know, is about being prepared and taking advantage of those windows when they are open.
And to talk about an M&A transaction and things that might impact that transaction specifically, not to harp on about this, but complexity of the transaction is a big one. So when you've got a purchaser that wants to buy your company, they are going to allocate a certain number of resources to that. They're going to be thinking about the cost of that acquisition to their business, to their people, shift of focus. And so they have a timeline in mind. There's flexibility with that timeline, but ultimately they have cost and time as a real driver for them. So if you're finding yourself in a situation where you've negotiated a really complex transaction that is just quite difficult to actually implement in the time, or the diligence has uncovered quite a few issues, which has meant that they've had to increase their spend or timeline to to burrow down into those issues, it can be enough to actually, to your point, time can be the reason that a deal might fall through. Another thing could be tax. So now I am not a tax lawyer, but often tax is something that people aren't necessarily thinking front of mind as they're kind of going through the transaction, and they might come up with a structure. So for example, a lot of structures have a scrip component. So you take on shares in the acquirer as part of the consideration. And for that, you want there to be rollover relief available. So you're not paying tax when you're receiving those shares. And if you don't follow the structure for the legislation to meet those requirements, your sellers can find themselves with a tax bill that they're not very happy about. And that can really affect the economics of the deal for them, and can be something that can also, make the deal die, essentially. So not to say you shouldn't have complex transactions. There's a lot of value in those, and complicated earnouts can be really great to get to where you need to be. But just thinking about the consideration structure, the earnout structure, and whether it's achievable in the timeline that you've proposed is a big one.
Great. Thank you so much, guys. We're going to transition, just because it's that time already, to questions from the audience. So if you haven't popped your questions in the Slido link, please do so now. We have our first one. So drum roll, I hope you're all ready. With the chances of a single product in a product portfolio to be acquired, is it best to position such a product separately in a different entity from the start? So I think the question is around when you have a business that has multiple products that could be separated out, should you be separating those out from the beginning?
Trying
Perhaps let's
to
start
take
with
this
you,
on
Madeline.
first. So look, you can sell a subsidiary entity, a company that holds that asset, or you could sell the asset itself. So there is flexibility for either option. Now, really the question is that asset standalone, or does your business use it as part of its broader business? Does it share IP? It's those questions that actually you should be thinking about when you're developing product lines to make the exit easier, rather than necessarily where it should sit within the kind of corporate group. Of course, if it's a subsidiary and you can easily facilitate the share sale, then that is generally a simpler transaction. The acquirer needs to be thinking about whether they're comfortable kind of taking on the risk of the shares, and there's kind of a liability question, but often that's fine. So that maybe is simpler than an asset sale, but ultimately the question is, what needs to happen to disentangle this asset from your broader business? And IP is usually the crucial one there. So does it share IP, and what kind of complex licensing arrangements are you now going to have to put in place as a result of divesting that asset?
Great question, audience member.
Can I just add one quick thing to that? Even as a
do.
listed company, we see a whole range of spin-offs. So if there's a particular product or business subsidiary, even as a listed company, you can then actually spin that off as a separate company listed onto the exchange. So that option is still there as well.
Oh, fantastic. And anything else that you wanted to add there?
Nothing from me.
Awesome, thank you. Great answers, guys. The next one is kind of around the chicken and the egg of, should founders be courting buyers, or should buyers be courting founders? The question comes from an audience member who wants to know, should founders actively be courting buyers? And if they are, how long in advance should they start that? And any tips on how a founder might be able to best position their company on the radar for a buyer? Jamie, I'm going to kick off with you on that one.
I think it depends on the stage of the company, but founders need to obviously focus getting the business to a scale whereby there is potential interest. Now, that interest could be from a strategic, it could be from a growth equity investor that's looking for a majority position, or to write a growth equity check. So what we find with a lot of the companies we work with is that once they get to a scale, and let's call it $10 million of ARR, they're getting incomings anyway. And you'll find a lot of especially the North American growth equity investors, they have teams that are always out there scouting, and they're making connections, and you should always have that introductory call. It may go nowhere, or it may come back in 2 or 3 years' time. So I don't think that, once you get to that sort of scale, that unless you're actually about to engage in a process, I don't think you need to be aggressively on the outreach. But certainly you go to conferences, you get to know who the main investors in your space are. There's a lot of literature out there which will tell you in your particular vertical who are the main investors. So get to know who they are, and then be happy to have an introductory call when people reach out. But if you think there's a particular investor out there that is a natural fit, and for example, a lot of the growth equity investors, they might have what they call a platform investment, looking for bolt-on acquisitions. So you might think you're too small, but it might actually be a neat bolt-on acquisition for their existing platform asset. So getting to know who are the other players in your space, who are the investors in those companies, and then at the right time, you might want to be reaching out to those guys just to make the connection. But you'll often find if you're building your business successfully, you'll get the incoming calls.
Yeah, and obviously the previous session was seed to Series A. Series A to IPO is a really interesting kind of discussion as well. If I take obviously IPOs are a much later stage, a much mature, more advanced sort of company. There's a real burgeoning pool of capital coming in the pre-IPO funds now in Australia, particularly over the last sort of 4 or 5 years. So the Perennials, the Allium Capitals, the Ellistons, the Regals, for example. There might be others, Jamie. But if that's the path that you're heading down, you don't need to do it by yourself. You can get that growth capital round a couple of years, sort of 18 months before heading towards IPO, and working with investors that are very sort of well informed and have taken companies through that journey as well. So that's getting to know your investor base, as you said, in regards to the strategic direction you want to take for your company.
Thanks, guys. The next question that we have here is, how would a founder incubate a competitive environment at exit to generate the best return for founders? Madeline, I'm going to pass that to you because I think that's more around like how do they structure their business in order to have the best return.
Is that like
any additional thoughts there?
A competitive sales environment, if the person is in the room, is that what you're saying? So a couple of buyers that might be interested? Because you can structure your exit as a kind of a bidding process if you wish. And that's quite a formal process where you do your own diligence on your own company, and then you send out your report, and the various acquirers come in and they kind of do their own diligence, and then they put together their proposal, and then you take their proposal to long form documents. So that is a well-trodden path, often for bigger businesses and the acquisitions that they kind of play in. So you can create competitive sales environments. But sometimes you might also find that the acquirer is looking for an exclusivity period. It's kind of like in a raise where they want to negotiate with you. So it's really about the steps that you take before you enter into exclusivity, where you're kind of scouting the market and you are getting a sense of what is an available option to you. So I hope I answered that question in the way that they wanted.
I think that was great. Did you have something to add there, Sasha?
Jamie, you might sort of have more detail on this, but there's a dual track process as you head towards IPO or an M&A or a sale. You can actually run both processes with your advisors to actually sort of work out strategically where that best value is. If you're saying you want to maximise your value coming out of that, I don't know, Jamie, if you want to add more to that.
Yeah, a dual track's typically for much larger companies, for the simple reason that if you're a company with an enterprise value of 1 to 200 million, you've got a limited audience amongst the institutional investors. And if you're trying to run a dual track process, often the institutional investors won't invest the time to do the diligence and actually work through the process if they think that at the 11th hour, the strategic investor is going to come in and take the business, and they just don't have the time to invest. So certainly for the larger companies, I think that's something that's certainly a valid option, but probably not for the smaller companies.
Yeah, and look, maybe related. It's just one point I wanted to sort of get out while we still have time. People ask me, what size does your company need to be to list, and what are some of the metrics around it? So very quickly, sort of mentioned enterprise value. We sort of, as much as you can be sort of 15 mil market cap within the listing rules, way too small for the sort of real commercial drive and position you need to be on the boards. So we really talk about a commercial sort of enterprise value of around at least 100, better to be 200 mil in market cap size. Some of the brokers I talk about or talk to, they, for a SaaS style business, they come up with metrics to 70-30-30. So 70% gross margins, 30 mil ARR, and 30% sort of annual growth rates. Those last two may be a little bit lower in the current environments, just on valuations and the like, but that's just very broad measures of the sorts of rough boundaries that might be out there.
Yeah, I'd just add to that. The reason that size is important is that's the size where you'll start attracting institutional capital at your IPO. If you're going to list and you're only going to have retail investors on your on your share register, I suggest you rethink your IPO, because it's all fine when markets are going well, but when markets turn to crap, then the retail shareholders go very quiet. Whereas at least the institutional investors, if you're still doing the right thing, doing what you said you were going to do, but market conditions are tough, the institutional investors, it's typically still there to back you and support you. So you need to have that minimum size threshold to attract sort of institutional investors.
Thanks. And actually on that point of the current environment and how that might change that 70-30-30, we do have a question which is specifically addressed to Jamie. Have you helped out any companies to do M&A as a bailout? So when they're on the brink of a shutdown, as an example, and how can a startup in that particular position still be attractive? And perhaps Madeline, you might have some commentary there as well.
Actually, Maddie might have the answers there because we haven't done any bailout M&A. Yeah, I might actually throw to you, Maddie, on that one.
Absolutely. So bailout M&A is still just an M&A transaction, and generally you might find that the acquirer is looking for something a little bit different in your business than what you were using your business for. So it might be that actually they're really interested in the software, and maybe the application of that software wasn't exactly right, which is why you've decided that this isn't the way you want to go. But there might be some really foundational, quality in there that they're really interested in. And so to the point, can it still be successful? Absolutely. You can still have someone that is very interested in your business, and it's just going to take a different path. So, but the transaction generally looks very similar. I would often say, though, from a structural perspective, the ones that I've done have been more asset acquisitions. So they actually buy the software. They don't take on the entire company because they may not need that. For example, they might not need all the people and things like that.
And what does that mean for founder equity necessarily in a situation like that?
So usually the founder, and unless the bailout is we want to absorb your business into ours and we want you to keep running it, then the founder can stay on, to my earlier point, and they might continue to have a shareholding, or they might participate in the new incentive schemes. So the founder can absolutely stay on if you found the right type of acquisition. If it's more of a, we like this part, but not this part, and we're just going to take that, often they're taking that to embed into their existing systems, and there may not be room for the founder, but it is still a cash exit. So if the price is right, then that can still be a great step. And then you can use that to invest into your next idea.
Great, thank you. And we have one last question for the day, and that is, so the exits that we're talking about might not be the last stop on the train journey. There may be a couple of other things that a startup does post initial exit. What might that look like, whether it's private equity, going back into another merger and acquisition? What are the next steps there? Is there anyone game to answer that one?
Maybe I'll start. So we found a lot of founders that have had a successful exit end up working with private equity groups because they've been through the journey. They can provide a different skill set to just the financial acumen that comes with private equity. So I think that's certainly one option. And then having a successful exit positions you well in the context of boards and advisory boards as well. And I'd certainly recommend for anyone, and part of this discussion around being prepared, having the right advice. And I know it's not easy for startups, they can't fund a board, but getting people into your network that can act sort of in an advisory basis that have been there and done that before is really important. So I think there's plenty of options available to founders who have managed a successful exit.
And I would just add that what we love to see in this ecosystem is those founders then, investing into other startups or creating new startups and continuing to kind of use their success to keep kind of contributing to the system. And we do see that a lot. So founders that have had a successful exit might start doing some kind of seed investing, or they'll just start again and with the next idea.
Yeah, I think from a listed company perspective, being listed gives you that publicity, gives you the profile. There's positives and negatives as markets, move around. I think it gives you the credibility as well. So as a founder, you're a very public sort of face in how you've perform and how you've grown your business. We've seen a lot of corporate activity, M&A activity. So the cycle of being a listed company. Fantastic. Obviously, we love the companies. There's 2,000 plus companies on the exchange that have stayed there. Things get taken out. We saw Nearmap. You've got Elmo example coming through. That happens. So there's a cycle of companies and a cycle of experience that comes through. So the more people that have been through that, I think within the sort of the Australian marketplace is nothing but positive for the future as well.
Well, Thank you so much, panelists. I think the audience can all agree that those are some really in-depth and really useful answers. I think we can also all agree that exiting is a piece of cake. Again, see what I did there. Thank you all so much, and please join me in thanking our wonderful panelists as well.